Okay, so part 2, we continue on with units of production, which is our next depreciation method. Now this one is used when we have an asset that we are going to depreciate based on its use per unit, which could be the number of pieces you make. It could be the number of miles you drive. So those are all going to be considered units. So the calculation for units of production is cost minus salvage, so similar to what we saw for straight line, except instead of dividing it by the useful life, we're dividing it by the total number of units we think it's going to last. So for example, if we estimate that it's going to last for, if it's a vehicle, we expect it to be able to be in use for us for 100,000 miles, then that 100,000 units is what we would use. Once you get that information, you divide it, and that gives you the depreciation per unit. And then for each year, you take that depreciation per unit times the number of units that you actually use during that specific year. So if it was a vehicle and you expected to last 100,000 miles, but you drove it 20,000 this year, you take 20,000 times that depreciation per unit, and that's going to tell you how much you would depreciate for that specific year. So let's look at an example for it. So here we have, it says that we have a cost of 10,000, salvage of 1,000, which gives us a depreciable cost of 9,000, 5 years, which doesn't matter in units production, and then we have units inspected. So we expect to make 36,000 shoes. So that's our total units of production. And they tell us assume that 7,000 units were inspected during the first year. So we're going to do the calculation like this. We're going to take, we have to first get our depreciation per unit. Now keep in mind, once you get that, that stays the same every single year. So your depreciation per unit's not going to change. It's associated with that asset and the units expected over the life of the asset. So we take our cost minus salvage, 10,000 minus 1,000 gives us 9,000, divided by the 36,000 we expect to make. And that gives us a depreciation per unit of 25 cents per unit. So to figure out how much we actually depreciate for that specific year, we're going to take 25 cents per unit, the depreciation per unit, times the number of units produced in that period. It told us in this problem there were 7,000 units inspected during the first year. So 25 cents times 7,000 gives us a depreciation for that specific year of $17.50. So we would debit depreciation expense for $17.50 and credit accumulated depreciation for $17.50. When we look at the schedule, again, it's important to be able to see this is telling you how many number of units they used for each year. So they had 7,000 the first year, 8 the second, 9 the third, 7 the fourth, and 5 the fifth. They gave them a total of 36,000 units, so they used all of their units in the 5-year period. We have a depreciation per unit. Again, it stays the same all 5 years. And then we multiply that out, and that tells you what you're depreciating over the life of the asset. Obviously, you should depreciate the asset fully to the depreciable cost, never below salvage value of 1,000. So our depreciation expense, you're going to see that listed per year for a total of 9,000. The next column over gives you accumulated depreciation. So our first year, it matches what we depreciated that first year because that's our first year. We haven't depreciated anything before that. Going into our second year, we're going to take what we had the prior year plus what we depreciated, this 2,000, and that's going to give us our accumulated depreciation of $37.50. Then we would continue to do that for each year. So $37.50 plus $22.50 gives us that $6,000. $6,000 plus $17.50 gives us a $77.50. $77.50 plus $12.50 gives us that $9,000. So we can see that we have the total accumulated depreciation. When we get to that total, that number should match your depreciable cost. And you can match that up over here. Total depreciation, accumulated, they should be the same. The other thing to look at is you have your book value. So we started with 10,000. That was the cost of the asset. Minus our accumulated depreciation gives us $82.50. We're going to deduct what we depreciate each year, and that's going to decrease our book value by the amount that we depreciate each year, all the way till we get to that ending number, which should be our salvage value. That's all there is to units of production. So when you're looking at the examples, they're going to give you the cost, the salvage value, the total number of units expected. They're also going to have to provide you with what were the actual units per year so that you can take your depreciation per unit times the depreciation per the amount of units per year. All right, so let's look at our last method under depreciation. So we have the declining balance method. It's also called the double declining balance method. And the reason is because it's double the straight line method. So what we do is we're going to take the straight line rate, and before we showed you a little bit of it, I said you take 1 divided by the number of years, and that gives you the percentage you're depreciating each year. So the same thing here. We're taking 100% divided by the number of years. That tells you what percent you're going to depreciate every year. So that's our straight line rate. So here we had 5 years, so 100% divided by 5 years. We're going to depreciate 20% per year under the straight line rate. But the double declining balance means you take double the straight line rate. So 20% times 2. So the first year we're going to depreciate 40%. And it's going to come off that top $10,000. So 10,000 times 40%. The first year we're going to depreciate 4,000. Now let's see what's different in our schedule in the double declining balance method. It is a little different. So we start out with our book value of 10,000. We're depreciating 40% each year, but 40% of the book value is what we're depreciating. So you'll see that we're looking for that beginning period book value. So here, when we first start, obviously the beginning is what we paid for it, 10,000 times 40%. That gives us depreciation expense of 4,000. Total accumulated of 4,000, which brings our book value, 10,000 minus 4,000, gives us 6,000. So that's our new book value at the end of our first year. We bring that amount down over here to the next line, to the next year. So we have 6,000 in 2020 times 40%. That gives us 2,400. So now we've depreciated a total of 6,400, and our book value is down to 3,600 at the end of year 2. So you can see that it's being depreciated much faster. In our straight line, it was 1,800 per year, so we're depreciating much faster than we were. All right, we're going into year 3. We bring that 3,600 down into year 3. Again, we're taking 40% times 3,600. We're depreciating 1,440 this year. It's giving us a total accumulated depreciation of 7,840 by taking that 6,400 plus 1,440. That gives us 7,840. Our book value is now down to 2,160. We bring that 2,160 down to year 4 times 40%. That's going to give us 864 that we're going to depreciate. Accumulated is 8,704, and our book value is 1,296. Now, what we have to remember is we can never depreciate below that salvage value. So we don't ever take it below 1,000. So if we had taken it below 1,000, that would have over depreciated it. So if we took 1,296 times 40%, we don't get that 296. We get a higher amount. And because of that, that is going to make it so we would have over depreciated. So what we actually have to do this last year, and this is only for the double declining balance, this very last year, you were actually looking at this number here, book value of 1,296 minus your salvage value, because you want to bring that book value down to salvage value for that last year. So salvage value is 1,000, so we're taking 1,296 minus 1,000. So we're actually going to depreciate 296. So we call that a plug number. So it's not an actual calculation. If you took 1,296 times 40, you don't get 296, right? So that's why it's a plug-in number. It's not your actual calculation. It's a number we use to get us down to the book value. If we had multiplied it by 1,296, that 40%, we would have gotten 518, which would have taken our book value down to like 777. So that would have depreciated it too much. So by using that plug-in number where we're just plugging in what is left to depreciate in that last year, that's what we're actually going to use. All right, let's look at the depreciation methods compared to each other. So we can see that straight line is consistent across the board, same amount every year. Units of production, it's based off of how many units we use. And that double declining balance is actually going to be using double the straight line rate as far as percentage wise, but it's based off of the book value. So we see that it's higher in the beginning, so you get the bigger write-off of an expense in the beginning, and it dwindles down as you age out that asset. All right, now when we think about depreciation, that what I've shown you is how it's going to be on your books, but I want to make sure that we point out that the tax system for depreciation is different. So for those of you who are accounting majors and are going to be doing taxes later, when you think of depreciation, it's a little bit different. So we're actually going to be using, for taxes, we use something called the MACRS, or the Modified Accelerated Cost Recovery System. And it actually gives you what percentage you're writing off each year, how long you can depreciate it, and it's based off of what category that asset falls into. So some assets might be 3 years, some may be 5, some may be 7, some may be 10. And it's going to tell you what percentage you will be allowed to depreciate each year. That way it's consistent across the board. All right, so one thing that we didn't look at, so far we've looked at just the depreciation for a whole year. But we don't always buy an asset in January every year. So if we didn't buy it in January, let's say we bought it in July, then we can't take the whole year's depreciation for it. We didn't have it for the whole year. So that's what we want to look at, is what does it look like if we have it for a partial year? So here we see a partial year depreciation, and it's showing that we bought it during the year, and this example was October 1st. So we have to factor in, well, how long did we have it out of the 12 months? So our cost was $10,000, salvage was 1, depreciation periods are 5. So, a full year would have been $1,800 per year, but we didn't have it for the full year. We only had it for 1 year, or part of a year, I'm sorry. So we only had it for part of the year. So if we're looking at that, then we're going to say, okay, we had it for October, November, and December. So we had it for 3 of the 12 months in 2018. So if we're using straight line, we would take the straight line basis, and then you just take that answer times 3 out of 12. So you could depreciate it for 3 out of the 12 months total. And that's what we're going to be looking at. So if it was a 6 months, if it was, July, then we would do 6 out of 12. So that's how we're going to be breaking it down. You can break it down into days also, but we're going to stick to just months. All right, the next part looks at, okay, so sometimes you're going to have an asset that you've had for a while, and you expected it to perform for a certain period of time, and you find out that it doesn't. So if that happens, you can do a change in your estimate, and it's adjusting it, so it's changing the estimate, and you could change your estimated salvage value, or you could change the useful life. And it just depends on things that you learn as you have that asset. So here's an example. It says, look at our machinery from the previous examples. Assume that it's the beginning of the asset's 3rd year. So it has a book value of $6,400, and it's determined that it will have a remaining useful life of 4 years. So it was supposed to be 5 total, but now we're in the 3rd year, and we're actually adding another year because we've done 2, and now we think we have 4 left. So we originally would have had 3 left. Now we're going to say we have 4 left. So we take that book value, and we're going to subtract out the salvage value. Now the other part of that is, the longer you have it, the less it may be worth in the future. So you may see that estimated salvage value be reduced also. So here we would take the revised salvage value of 400, went down from 1,000 to 400. We divide that by the remaining years, and we're going to see a $1,500 depreciation for the rest of that time period. The next slide just shows you the asset impairment. So if we have a permanent decline, we're actually going to write it off. Okay, so we will continue this in part 3 in the next part.